Guys, welcome back to this yet another lecture. In this, we'll be continuing the chapter 4 of our economic survey from where we have left out, and we'll also be discussing the basics required to understand that. In the previous video, we have dealt about the monetary developments and the money aggregates topic and the important issues from prelims perspective. In this video, we'll be talking about the next topic that is there in the chapter 4 of our economic survey this year about the liquidity conditions and its management and all the basics that are required to understand that. If you haven't watched the previous video, I request you to go back and watch it. Before proceeding with this lecture, let me give a brief context. Those who were following the Hindu Highlights channel would already know about this. But to those who did not follow this, let me give a context. So even before the pandemic struck us, our economy was under a slowdown and our growth rate was hardly around 5%. That is the GDP growth rate. And when we were discussing in the previous video about the concept of velocity of money, we have already seen how economy is nothing but a cycle, and NBFCs, that is non-banking financial companies, are one of the weakest links in the list of institutions controlled by RBI, and it is very crucial for our economy. So keeping this in mind, RBI wanted to infuse liquidity into the system. The concept of liquidity and its relation to growth was already discussed there. So this is the context. After the pandemic struck, RBI took certain measures, and over the next couple of years, what were the actions taken by RBI forms the content of this video. So for that purpose, I will also be explaining the concepts which are important for our prelims examination. So this is the screenshot from economic survey, and economic survey's first paragraph says that liquidity was in surplus. Now, when you have an economic slowdown and when there was surplus liquidity, then why is RBI actually infusing more money into the system? For this, you have to understand more details. In an economy, we have two sides, that is the supply side and the demand side. On the supply side, we have the producers, and on the demand side, we have the consumers. Now, what is the role of the government here? To help both the suppliers as well as the consumers. The metric that is taken into consideration is inflation. And when this inflation, that is the consumer price index, which we have discussed in the previous videos, and the basics were discussed in the second video. If you haven't watched it, please go back there. So we have already seen how monetary policy committee decides that the ideal inflation rate for our Indian economy is somewhere between 2 to 6%. When the CPI is in this range, it is said to be within range, or it is range bound. Now, when this is not happening, this is where the Monetary Policy Committee changes its policy rate. Now, what is this policy rate and what is the significance of this monetary policy? Let us understand. So, in order to control inflation, the government can use monetary policy and fiscal policy. Fiscal policy means all the measures that the government of India through Ministry of Finance and various other ministries takes. And monetary policy is primarily the action of RBI as a controller of cash flow in an economy. So this monetary policy pertains to all those decisions taken by RBI. So it is by RBI. And what is the purpose? To control money supply and interest rates in an economy, which will spur economic activity. Now, what is the impact? One of the impact we have already discussed is inflation. If it is within range bound, consumption will increase, savings will increase, investment opportunities will increase, and ultimately it will lead to capital formation. Now, am I making up this components? No. If you remember the GDP formula, C plus I plus G plus net exports, that is X minus M, I'm basically talking about these things only. So monetary policy affects growth rate by helping each of these components. That is what you have to understand. Previously, RBI used to set these policy rates, but the government observed that there was no legislative backing to this rate and there was no accountability. So what if RBI fails to achieve this inflation targeting objective, inflation targets? So keeping this in mind, in 2016, the RBI Act was amended and a monetary policy committee was created with the sole objective of setting only one policy rate. What is that policy rate? Only one mandate. Please remember this, that is repo rate. So this is the only objective of monetary policy committee. Now, what is it taking into consideration while deciding this repo rate is inflation targeting, obviously. Second, other intangible benefits which are indirectly impacted by this inflation rate, obviously economic growth, as we have already seen. And when capital formation is happening, job creation will be done, and it will address the issue of social justice by ensuring inclusive growth. So this is the vision that drives the monetary policy committee and the governments. Here is a question that was asked in the channel a long time ago. So a lot of people made mistakes. So monetary policy committee sets reverse repo rate also. This was a question asked. And monetary policy committee has a legal mandate to set reverse repo rates in order to maintain the CPI at 4 plus or minus 2. Remember, monetary policy committee's only objective is to set repo rate. Now, what is this repo rate, reverse repo rate? Let us try to understand. As far as the source for this is concerned, you can take a look at this article by Urjit Patel, the ex-governor of RBI, wherein it is clearly mentioned that the reverse repo rate is not set by monetary policy committee. So this ends the controversy. You can also go through RBI documents if you have any doubt. Moving on. What are the different kinds of monetary policy tools that are available with RBI? Basically, they can be categorized as quantitative, that is, a number is associated with them, and qualitative, something that is intangible but will definitely have an impact on monetary policy. In this video, we'll be trying to understand the quantitative tools of RBI. The first set of quantitative tools constitute CRR and SLR, statutory reserve requirements. Now, when we were discussing about the concept of money multiplier, we talked about a reserve ratio, which is used for creating money in an economy. That is, when we were discussing about this money multiplier concept, we have already discussed this elaborately. If you haven't watched it, I request you to go back to the previous videos. So this CRR, or the cash reserve ratio, is actually mandated by RBI directly in the act itself. And mind you, there is no ceiling which is given in the RBI Act as to what should be the cash reserve ratio in an economy. Why is this set aside, and all those points were discussed already, so I'm not going to repeat them here. Will the banks earn any interest by keeping this money aside? No. Is there any exception? No, it is mandatory for all banks. However, RBI can fix the percentage as it may desire from time to time. And what is its utility? It creates money multiplier. We've already discussed this. Now let us come to this statutory liquidity ratio. When I say statutory, you have to understand that it is having a legal backing. Now, what is the law that is mandating this SLR? Is it the RBI Act? No, it is actually the Banking Regulation Act of 1949. So what I mean to say is, banks or any financial institutions are basically companies. So first they have to register themselves as companies, and once they register, they need to have a license from RBI. Now, when will RBI give license? When it adheres to certain norms which are laid down in the schedules of RBI Act 1935 or 1934. So once those norms are fulfilled, the banks get a license, and they have to continue to abide by the rules which are laid down in the Banking Regulation Act. Now, one such rule is this statutory liquidity ratio, SLR. Now, the purpose of CRR and SLR, when you look at the larger picture, it might seem like they control money supply, but if you specifically look, this is to avoid a bank run situation. Like, all the people would, if they come to the bank and demand money at the same time, banks cannot give entire deposits back to the depositors at the same time, because those money will be in circulation in loans. So to avoid that, SLR is there, and for CRR, the purpose is to cushion the economy from destruction of M0 or the reserve money that RBI creates. Unlike in the case of CRR, SLR has a limit which is set in the Banking Regulation Act itself. So SLR can't be more than 40% of NDTL, that is the net demand and time liabilities. In simple words, whatever money that bank has in a 14-day window, of that maximum SLR that RBI can dictate is just 40%. It can't be more than that. Now, normally banks function like this. Let's say a depositor X gives money to the bank uh, in a form of a fixed deposit. Bank will lend that money to a person Y at the interest rate of 10% and will give 4% back to the depositor. This 6% is the income that a bank will earn. Now, essentially, if you are saying that SLR is 40%, you're actually blocking away 40% of bank's money from generating income. So, is this valid? Is the question. But unlike in CRR, where interest is not earned by banks, in SLR, the banks are allowed to hold liquid deposits like, say, cash, gold, government securities, T bills, state bonds, and any other government securities or any other securities which are notified by RBI. So essentially, they will earn interest by having this SLR quota. So it is not right to say that banks are denied the opportunity to earn interest in SLR. So this is to ensure that a bank run will not disrupt the banking system. Now, what is a bank run? If all the depositors like X say that we want our money at the same time, bank should recover this loan that they have given from people like Y and then give it to X. So it is not possible for all the money to be given at the same time. It is in this kind of scenarios SLR will help. So this is the difference between CRR and SLR. A lot of questions were asked in previous examinations. And how does SLR help dealing with inflation? If you are actually increasing SLR, it means that the cash is actually pulled out from economy to reduce the inflation, and the opposite is also equally true. Same logic can also be applied for CRR also. Based on this simple logic, a lot of questions were asked. Please solve the previous year questions. Also, what is this government security, T-bill, state development loans, bonds, etc. We will be discussing in further lectures. Now, what happens if this CRR and SLR are not maintained by the banks? So there is a penalty rate called the bank rate, and according to the repo rate which is set by the Monetary Policy Committee, this bank rate will be certain X% more than the repo rate. This is called the bank rate or the penalty rate. Before repo rate and policy rates were brought into the picture, the bank rate stood as the benchmark for other banks in our commercial banking system to use them as a policy rate. Now that we have a repo rate, the practical utility of a bank rate is just to impose penalty on banks for not adhering to this CRR and SLR norms. Now it's quite possible that banks, let's say for example HDFC, it is falling short of certain amount of money to meet the CRR and SLR norms. So it might borrow some money from either SBI or go to RBI. Now, why should these banks give, or why should RBI give certain amount of money to HDFC? What is the incentive? This incentive is nothing but the interest that these institutions might earn by giving money to HDFC. So that interest rate is called the marginal standing facility rate. Remember that is it is always short term. Overnight to 14 days is the time period. What is the guarantee that HDFC will actually return this money to RBI or SBI, as the case might be? Because of this, there is a collateral. What is that collateral? Whatever SLR quota government securities are there, those will be mortgaged by HDFC at RBI or SBI. So basically, it's an agreement that within the stipulated short period, we will pay the interest and the principal. Otherwise, you can keep this government securities with you. This is the agreement. So this marginal standing facility rate is also repo plus X%. Usually this bank rate and MSF rate are almost equal most of the times. Now, what is this reverse repo rate? Let us understand. Before moving on to the reverse repo rate, this is a screenshot from the economic survey explaining the trend of policy rate. Okay, so policy rate as in the repo rate which is set by the monetary policy committee. As you can see, from a very long time it has remained unchanged by the monetary policy committee. Now this monetary policy committee meets once in every 2 months. It is not important to remember the numbers here, just understand this graph. Now imagine a scenario where the deposits of banks are increasing, but there is actually no one to take loan in that time period. So why should banks lose interest? So they want to invest that money somewhere and actually pull it out very quickly whenever there is a customer. So this is the interest of banks. Now, if there is no other option, banks would deposit that money back with RBI because RBI is actually the banker of banks. Sometimes even RBI wants to take money from the banks. For that, RBI should also give certain interest, right? That interest is called the reverse repo rate. And usually this is set by RBI directly, not by the monetary policy committee. Remember, this reverse repo rate is repo minus X%, the same X which is usually the percentage taken for marginal standing facility also. Now you have to remember that this marginal standing facility is available only for banks, and this facility is dependent on the policy rate called repo rate, which is set by monetary policy committee. Does that mean repo is only useful for this single facility alone? Not really. We will be seeing the other important facilities also. Here we have the liquidity adjustment facility. This is also similar to what we have seen in marginal standing facility. There, banks were actually borrowing money to meet CRR and SLR requirements. But in liquidity adjustment facility, it is not just the banks. Banks and there are certain other clients of RBI as well. Now, who are these clients? You can read from this document screenshot, which I'll be posting in the channel. The link of the channel will be placed in the description box below. So these are the clients, like they include non-banking financial companies, mutual funds, insurance companies, state governments. All this will be a part of this liquidity adjustment facility. So the same logic of reverse repo and repo will apply here also. How is it different from MSF? When banks want to participate in this liquidity adjustment facility, they can't use the SLR quota government securities. Over and above that, if banks have certain G-Secs where they invested, that part can be used for availing the liquidity adjustment facility. And the opposite, if RBI is actually uh, taking money from the clients by giving government securities, the interest that they will earn is based on reverse repo. Okay, clients, remember this important point. Clients, who are the clients? You can read from this document by downloading this, which will be given in the description box below. Economic survey talks about a new concept, variable rate reverse repo. So this is actually used by RBI for a particular reason. We'll understand what is the reason here. COVID lockdown happened in March 2020. Obviously, there will be no economic activity during that time. Hence, no loans were being taken and the funds were lying idle in the banks. Across the world, the same situation was repeating. So, RBI noticed one peculiar behavior. Banks were not working hard according to RBI, and they were just depositing that money with RBI for reverse repo interest, because instead of letting them lie idle, the stock markets were crashing and all the mutual funds, investments, and other instruments where money can be invested were performing very horribly. So reverse repo seemed like a very comfortable option for banks, and therefore they were earning a basic interest around 3.5% when the entire economy was not performing well. So this is not going to help the economy, and this is where RBI decided to come up with the concept of variable reverse repo. Firstly, they reduced the repo rate and made it not attractive for bankers. The second thing that they've done is variable rate reverse repo. The first thing that you have to note here is it is not mandatory for RBI to accept all the money that is coming to them from banks. It is the bank's responsibility to go out there and find customers no matter how the situation is. So basically, by imposing this restriction, a bidding process will be started, and the clients, let's say for example, in this case, HDFC and SBI, whoever is willing to park their money for low amount of interest, their money will be taken first by RBI. Not only this, there is also enhanced reverse repo rate. That is, more interest will be paid to those participants if they fulfill certain conditions. Those conditions include sector specific on tap liquidity window. Now we'll be looking at this in the next few slides. And also, if certain targets are reached by these banks or the clients, they will be incentivized with higher reverse repo rate. The details, the numbers, etc., is not really important. Just understand this logic. The same thing is also mentioned in this screenshot taken from the economic survey. On tap liquidity window of 15,000 crores per contact intensive sectors. Now, what is this? Let us understand. Now, why is it called on tap? Just like a tap, whenever we open the tap, it meets the demand for our water. On tap, similarly, here means whenever the demand arises for banks, who can go to RBI? The bankers can go to RBI, not individual customers. And when we say the contact intensive sectors, we mean like say hospitality industry, tourism industry, hotel industry. They have lost their jobs in the pandemic. So to help those particular sectors, RBI came up with this scheme. So all types of banks, if they are giving this loans to the contact intensive sectors, those banks can approach RBI. And similarly, there is something called targeted long-term repo operations, which we'll be discussing. So MSMEs and unorganized sectors would be getting help from small finance banks only. The logic and everything will be discussed in the next few slides. So RBI has managed to maintain the surplus liquidity using this variable rate reverse repo operations. That is the same thing given in the economic survey, which we have already seen. Now moving on. Amongst other steps taken by RBI, one of them is also about refinancing the all India financial institutions. So these financial institutions target specific sectors, like if you're talking about rural development, we have NABARD, or if you're talking about the housing sector, there is the National Housing Bank, and you also have SIDBI. Let's not get into the details of this because it is beyond the scope of this video. So this refinancing facilities provided by RBI will provide the liquidity to achieve their objectives. What are their objectives? Let us discuss in another video. We have discussed about the liquidity facility for healthcare and also the on-tap liquidity window of RBI. Now let's talk about this concept of long-term repo operations and what this particular concept means. When we were discussing about repo, we have discussed that the maximum time period is not more than 14 days. Now, why are we actually calling this operations long-term repo operations? Isn't it contradictory? Not really. So, what is happening during the COVID times and even before that is that loans were not being taken despite having surplus liquidity in the system. So, in the COVID times, we wanted people to take up more loans at a lower interest rate. So one way to push loan activity is by reducing interest rates charged by banks. But even after reducing the policy rate, that is repo rate, banks were not actually passing on that benefit to the customers. Now, what does this mean? Let's say SBI. SBI charges 10%, for example, on a home loan, and this was when RBI was actually having a repo policy rate of say 4%. But even after reducing this to say 3 or 2% hypothetically, SBI has not been reducing this interest rate that it is charging from 10% to, let's say, 7% or 8%. Now, why is this happening? Why is there a poor transmission of monetary policy? Let us understand. Now, let's imagine in a bi-monthly monetary policy committee review, the committee decided that 4% is the policy rate, that is the repo rate. Now, does that mean SBI will actually start giving loans out for 4%? Not really. So, SBI comes up with its own benchmark, let's say X%, and over and above that, different category of loans will have different percentages. Let's say X% is the benchmark set. So SBI can say X% plus 3, let's say it is 10%. 10% is the interest rate that SBI would charge for home loans, or for vehicle loans it can be X plus 5%, or they can say 12% is the interest rate that they will charge for vehicle loans. So different category of loan products will have different interest rates. Now, how do they arrive at this interest rates is the question that we have to understand. So in 2016, a concept called the marginal cost of funds based lending rate was introduced by RBI, and they said that, banks have not just deposits, they source their funds from different sources. It is not important to understand the nuances of the mechanisms which are involved in sourcing of funds. Just understand that a lot of channels are available with banks to achieve this fund target. Now they have to pay interest back to the origin of those fund sources. So the marginal cost of funds include CRR, and there is a marginal cost of funds for acquiring those um, funds, and over and above that they have to make some profit, right? So that is called the spread. Now, why did RBI actually recommend this in 2016? Because banks were complaining when asked about the reasons for not transmitting the monetary policy changes. So, in 2016, in order to increase transparency and also ensure better monetary policy transmission, RBI came up with this MCLR method. Did it work? Not really. How can we say? In January 2019 to October 2019, if we take a look at the decisions taken by RBI, the repo rate actually came down by 135 basis points. That is 1.35% almost. But did banks actually reduce their interest rate that much? No. It was just 40 to 45 basis points. And the banks cited non-performing assets and lack of business activity as the reason for not transmitting the policy. Now, therefore, on 1st October 2019, RBI said, we understand your concerns. So let's go for a external benchmark. Now this external benchmark can be some X%. So over and above that, banks are allowed to have a spread, that is their profit cut. And also when you're risking by giving a loan to a particular category, let's say a bank is giving two-wheeler loans. So there is a possibility that the borrowers might default on these loans. So there is a risk premium involved in lending out products. Banks will take certain insurance against such risk. So that is called risk premium. Since this is also included in the calculation of this interest rates, and external benchmarking was considered to be more or less successful in monetary policy transmission. Now, what are these external benchmarks? Let us understand. So what are the external benchmarks? These are the external benchmarks. So what is this T-bill and what is bond yield will be discussed in the subsequent videos. Just remember this for now. Also, apart from this three indicators, you also have something called the Financial Benchmarks India Limited. If this organization recognizes certain external benchmarks, even those are recognized by RBI. Banks can use these benchmarks also. Now, to which category of loan products is this external benchmarking allowed? Because there might be conspiracy theories and accusations that the government is actually helping out big corporates. So this is applicable only for the following categories, that is personal loans, because they have a very high interest rates. it is also applicable for retail loans like home loans or two-wheeler loans or four-wheeler loans, which are consumer driven. Like if the products generate continuous EMIs, they are considered to be a good business because the cash keeps on flowing. So retail loans. And then you also have MSMEs. Usually only the micro and small industries were considered in the initial stages, but after April 2020, even the medium scale industries were also added to this list, where they can have um, interest on external benchmark. Also, if the old customers think that they will get profit by subscribing to this new methodology, they can express their interest by writing to the bank. That is also given in RBI notification. Thus, we have understood the problem of poor transmission of monetary policy. But during COVID times, there was another problem. Money was stuck because businesses were not happening because of the lockdown. Now, just after the lockdown was lifted or unlocking of our economy started, there was no way that liquidity was there in the system, because as such liquidity was in surplus, but because it required an impetus, one way to push loan activity was by further reducing the interest rates, but that is not possible for uh, the RBI because of inflation targeting. Now, inflation was well within the range, and if we actually reduce our repo rate, it will harm our economy. So, long term repo operations route was taken. Now, let us understand what this is actually. When they say long term, it is usually greater than 1 year. So in this particular case, we're talking about loans which have a tenure of 1 year and 3 years. So RBI decided that it will lend nearly 1 lakh crores to banks. So why are banks ready to accept it? Because they're getting this at a repo rate. Repo rate is usually very less when compared to the long term loans. So they're getting cheap money. So it is a way by RBI to encourage banks to use this money and make them work so that they have better business, or it will also create economic activity in the economy after the pandemic. This is the objective with which RBI went ahead. So what this means is, let's say if the repo rate is around 3.5% and the long term rates are usually somewhere around 6 to 7%, now banks would be getting it at 3.5 to 4% only. So that is an advantage for banks because they can um, lend this money very cheaply, and even consumers will be willing to take this money because instead of 10 to 15% interest rate, now they might be getting it for around 6 to 7% or 8% maximum. So this is a win-win situation for the economy. Now, another form of this long-term repo operations is when long-term repo operations happen to be targeted towards a particular segment. So the tenure here, as declared by RBI, is 3 years. Now, let us not get into the details of this long-term repo operations. Just understand that it is targeted towards a specific sector. Now, how is it targeted? Let's say if you're talking about non-banking financial companies, if they're badly hit by the pandemic, so banks are forced to give money or forced to lend to these sectors to spur the economic activity back into action. And another important point is they're time bound. Let's say if some X crores of money is lent to a bank like SBI, now a certain percentage of this, let's say a percent, is supposed to go to a particular sector B within some 2 months. This can be the condition which is laid down by RBI. This is just an example. So it will help in timely access of funds to these particular sectors, and that is the objective of targeted long-term repo operations. Now, as per RBI, what are these sectors? So mutual funds, non-banking companies, housing finance corporations, real estate sector was really stuck during this time. But lastly, and very important thing, even corporates could avail this facility. So if banks give certain loans to these corporates, even then they are eligible to access this cheap loans. So now we have completed this topic of liquidity conditions and its management. So the next video would be about the developments of GSEC market. If you like this video, I request you to please like, share and subscribe, and you would find the PDF of this in the following Telegram channel. So that's it for now. Thank you.